As of today, it has been 40 days and 40 nights now that the government has been shut down. It has affected some of us quite a bit. If you're a government employee, it could be affecting you in ways that you did not expect to be affected this long. What I mean by that is no paycheck. If you are if you are in need for government services to help do your job, for instance, maybe you are a consultant and part of your job involves flying back and forth. You might be delayed. You may have seen delays or cancellations due to the fewer and fewer TSA agents that actually are going to work because they can't get to work because they're not getting paid and they can't pay for the gas and tolls to get to work. And the list goes on and on. I call it kind of trickle down government shutdown. Well, looks like the government, as of just minutes ago, inches closer and closer to reopening the government. The Senate is coming to a deal involving SNAP. It looks like 8 senators are going to break with fellow Democrats. It was only going to be a matter of time before the, regardless of your political affiliation, where senators realize that this shutdown, regardless of what side you're on, is going to be bad for you come re-election. It's going to be bad for you if the American public continues to look at all Republicans, Democrats, Independents as just getting in the way, and they would look for more change. So they're trying to get this wrapped up. It looks like obviously you got to go back to the House. And then, of course, Senate and President Trump has to sign off on this before reopening. And I imagine that the deal will be done by the end of this week. Markets have been reacting. We started out last night. Markets reacted over late weekend, jumped up. There was some issues beforehand that pushed the crypto markets higher. And then I think it was President Trump had some tweets out about stimulus checks going out from tariffs, and that pushed the markets really hard and soft assets higher. And then again, news came out last night that leaked out that the government was looking to reopen, and of course that pushed the markets even higher. We saw highs that came in really right around, I think about 10 o'clock. We saw highs in the stock market before pulling back. So let's get into it. Let's talk about what we see happening. And I really want to start off by really kind of reminding everybody where we were last week and even last month before the shutdown. So in November, looking at seasonality, which is what I do. I look at seasonality, and seasonality for the majority of the last decade and even several decades, going into the last 2 months of the year, has been very profitable if you were on the long side of the market. Not just the November, December area, but but when you look at the 6 months that start in November 1st and April 1st, you'll see that over decades, 50 years, it has resulted in positive moves in the stock market. So there's a lot of layering that goes on in seasonality that really pushed these markets to continue to project higher. And of course, the shutdown, when we see things that are something that you can't look at, something that has never happened before. You might argue with me and say, Tom, we've seen shutdowns that happen a lot. Yes, true. But we've never had a shutdown that's lasted 40 plus days. And that in itself really took over and was front page for the markets as we move forward. So I talked about, coming into the big, this was 10 days ago, we talked about November, December. We talked about the best 6 months of the year here. We just discussed this last week. Hey, I'm Tom Gentile, America's pattern trader, and markets get rocky this time of the year. But this isn't my first rodeo, but the money counter is still delivering stock patterns with a 90% or better probability of profit, even in September, one of the bearish months in the market. Hey, get the patterns, the trades, and my playbook for just $9. So let's have a look and see what's happened now that the shutdown looks to be ending. I want to look at stocks, bonds, currencies, commodities, and I want to end with volatility when we look at the overall market. So for that, I'm going to move to charts themselves. So we're looking at charts here, and I call this my all-in-one chart because it is showing me pretty much the things that I want to see. So on this chart, and we're looking at SPY right now, we see what I call channels. All right, I look at long, intermediate, short-term trend channels. That is what you see in red, and then also over here, it's hard to see it in green. And if I have an intermediate or short-term channel, you can see actually two channels on here. Right now, I see two for this particular chart, but there's channels on the screen. There are Fibonacci retracements, and we see that based on the low of the chart to the high of the chart. All right, in this case, the low of the chart, and I'm looking at June, right? Sometime around the middle of June, we saw a small pullback in the S&P that brought us back to below 600, the high at 687.39, and what we've seen as far as a pullback so far. And then the last of the three big things I see in this chart is this blue line on close. It goes down, goes up, goes down, goes up. That is the implied volatility on the asset in question. In this case, the S&P 500 or SPY. So when I look at this whole chart, what does this chart actually tell me? It tells me that short and intermediate term trend channels are still moving in upward direction for SPY. And so I can see we've had some bounces here. Well, the first bounce was obviously here in the middle of June. We had another bounce that occurred let's call it middle of October. And then the third bounce actually happened on Friday, where we hit some trend channels. We've hit Fibonacci levels, although those were not true Fibonacci levels because they're based on what's happened so far and did not include the actual high. But as I can see, we're still clearly in the bullish camp. The big thing is the gap that happened earlier today. And of course, the move down in implied volatility. So if you look at the implied volatility move, we are at about half the distance between where the lows were in IV and the highs. So they have come down from the highs that happened about a month ago. Right? So everything tells me that the SPY still is in the health of the stock market for the S&P 500 still remains good. Looking at the QQQ. I thought I'd throw the NASDAQ on her because it has been the strongest, and it's also been hit the hardest in terms of market sectors. The Qs also had a mid-June low, if we're looking at summertime, at 526.67, up to as high as 635.77, and its pullback. And as you can see here, channels are still up, channels still look good. We had a pullback that took us through the short-term channel and to the longer-term channel, and we bounced off of that on Friday. In fact, Friday was interesting because today we actually bought back the last hour of the day. So there were traders that thought something was going to get done this weekend, right? There were traders that decided that because the November elections were now out of the way, that it was time that government got back to work. And smart traders bought on Friday afternoon. Obviously, they look even more smart coming into today as we've started the gap higher. Volatility's come back a little bit on the Qs, but volatility in the Qs still remains high, which tells me that if I'm going to look at a NASDAQ stock, if I'm going to look at a tech stock, I'm either going to A, sell premium as an option trader, or B, I am going to at the very least, spread my options risk. That means creating vertical spreads if I don't want to be a put seller. If I want to trade the Qs higher, I would look at creating spread opportunities off of the move that we're seeing this morning. Let's continue on. Here is a chart of the bonds. The bond market is finally moving in the right direction. And what I mean by that is I mean the direction where interest rates are likely to go lower. So if you go back to the second week of July, we saw lows that popped in down here in the 85s. The highs came up to the low 90s. We did get a pull, and that pullback was substantiated by a move to and just through the 38% retracement area. That's where we're at currently. But trends are showing higher lows, higher highs. Longer term trend actually looks better than the short term trend, but the short term trend is still intact. The one thing that really interests me about this is that until just the last week, volatility was as low as we've seen it for the better part of the summer. In fact, I think the better part of the year. But it has, in the last few weeks, crept higher as this government shutdown has really kind of stifled things. But with that apparently going out of the way, that could lead to higher bond prices. That could lead to lower implied volatility in the bond market. So bonds are still up, which is really good for the stock market right now. Moving forward to cash, this is a real interesting one. UUP has, for most of summer, just in the last week, became a very expensive asset when you look at it compared to where it was on its lows. The lows before July 4th were down here in the 20s, the high 26s, but we've jumped to the low 28s. That's a pretty big move. Now, I would look at that and I would say, what's going on with the US dollar? But again, UUP, first of all, it's a double dollar. So when I say index, it's an index against foreign currencies, not against the stock market, not against commodities. So as long as we don't see anything that goes above the price when we saw COVID, then I wouldn't be too concerned about UUP because, again, it's a comparison of the US dollar versus a basket of foreign currencies. Moving forward, oil still continues to move in the direction we expected it to since mid-July. Come mid-July, USO was trading near 80. Where's it at right now? Down in the low 70s. I expect that that's going to continue to slump. And it's because of the fundamentals of drill, baby, drill, but also because of the seasonals, and we are currently out of season on oil and possibly fossil fuel energy stocks, right? So I would continue this. I would expect this trend to continue into the new year. Moving over to GLD, and you can see GLD has, again, the lows that occurred during the summer. We're down here really towards the end of July when we were around close to 300 for GLD. Since then, we moved up above 410. That was an incredible move on gold. And at this high, it also were stoked with long lines at places where people buy bullion. Since then, we've seen a pullback to the 38% retracement level. But what has happened in the last couple of days? We've started to jump higher. So my expectations are that gold will, at the very least, come up to its resistance level at 403.15. And finally, finally in the asset area, SLV. SLV2 had lows in the low 30s, went up to as high as, it actually touched $50 before pulling back. It is now kind of came back, and then today, as we're seeing right now, SLV in the mid 40s. So it has come back from being really down around $41 just, 2 weeks ago. Now we're up in the mid 40s once again, trading above $45. That is for SLV, as silver itself is trading close to $50 an ounce again when I was looking at the futures markets earlier this morning. Finally, the VIX. All right. What is volatility saying about this market? Well, volatility is telling me that even though we've had some concerns about this looming and extended government shutdown, that the VIX is trading very, very close to its lows for the year. My expectation is once this is the government we have a government bill extending us into January, that we're going to see new lows in the volatility VXX. And my expectation is that we'll see lows down in, this is VXX now, in the low 30s, maybe even slightly below 30, which puts the VIX itself down below the teens that we're seeing trading now. So as we look at those, what do we have? Well, summary tells us this: the 40-plus day shutdown has hurt the markets for much of the last 40 days, especially bullish projections. And regardless of whether you were a seasonal trader or a technical trader or even a fundamental trader, this has been a hard last month to trade. Best thing that you could have done, other than buying good assets, is as an option trader, put yourself out past what you expect the shutdown to do, but also with the expectation that volatility could swing highly no matter what it is you were trading. Right? We saw that actually happening with our own accounts. And so again, pushing that time frame out is a big help. With the shutdown coming to an end, here's what I expect. I expect a kind of a sell the news event to happen. And I thought it was going to happen at 9:30, didn't happen until 10 a.m. But we are getting a bit of a pullback. But market should be gearing up for new highs and holiday moves to happen very, very soon.